Markets don't fear bad news. They fear what most people haven't noticed yet. Let me challenge a common assumption. Most investors believe price volatility is driven by headlines. A crisis here, a policy announcement there, or a sudden shock that spooks the market. But markets rarely move violently because of information everyone already sees. They move when something changes beneath the surface, quietly, structurally, while attention remains fixed elsewhere. Right now, many people are asking the wrong question about silver. They're asking, why is the price moving so much? The better question is, why does this volatility suddenly make sense? When uncertainty rises, markets don't respond evenly. Assets with dual roles, part financial, part industrial, often react first and most aggressively. Not because they are weaker, but because they sit at the intersection of multiple pressures. And here's the uncomfortable truth. By the time volatility feels obvious, the underlying shift has already happened. What we're seeing isn't about panic, it's not about fear, and it's not about predicting where prices go next. It's about recognizing when the environment itself has changed, even if the narrative hasn't caught up yet. Before we look at charts, before we talk forecasts, and before we draw conclusions, we need to establish one thing clearly: what has actually happened and what has objectively changed compared to just weeks ago. That's where clarity begins. Over the past year, the silver market has experienced unusually large price swings compared to its historical averages. Daily and weekly volatility has increased, with sharper advances followed by faster pullbacks than those seen in more stable periods. This volatility has occurred alongside a broader rise in global macroeconomic and geopolitical uncertainty. Widely used measures of uncertainty, including composite indices tracking policy, economic, and geopolitical risk, have moved to elevated levels compared with recent years. These indices are descriptive tools, not forecasts, but they confirm that uncertainty has intensified rather than eased. During this same period, gold prices have generally remained firm relative to their longer-term ranges, reflecting continued demand for traditional reserve assets. Silver, by contrast, has shown more pronounced fluctuations, consistent with its dual role as both a monetary metal and an industrial input. A notable development has been the persistent price difference between regional markets. In China, silver has traded at a premium relative to U.S. benchmark prices, particularly those referenced to COMEX. This premium reflects localized supply-demand conditions, transaction structures, and delivery preferences, rather than a single global price mechanism. On the regulatory side, Chinese commodity exchanges have publicly announced enforcement actions against trading accounts found in violation of existing rules. These actions include account suspensions and restrictions, and are part of routine regulatory oversight rather than emergency measures. Separately, both China and the United States have continued to emphasize the strategic importance of physical commodities and critical materials. In the U.S., official government publications maintain updated lists of critical minerals, which include silver alongside other metals essential for industrial production, technology, and national security applications. Compared with last month, there has been no single triggering event. Instead, the change has been incremental. Volatility has increased, regional price differentials have persisted, and regulatory scrutiny in key markets has remained active. Taken together, these facts describe a market environment that is more sensitive to shifts in liquidity, policy, and physical supply conditions than it was in calmer periods, without implying any specific future outcome. To understand why recent developments in the silver market matter, it is necessary to look beyond daily price movements and examine the underlying chain of cause and effect. At the first level, elevated volatility reflects a market adjusting to tighter conditions. When uncertainty rises across currencies, interest rates, and geopolitics, capital tends to move more quickly and less predictably. Assets that sit at the intersection of financial markets and real economic activity are often affected first. Silver is one such asset, as it functions both as a store of value and as a key industrial input. At the second level, regional price differences highlight how fragmented the silver market has become. A persistent premium in one region relative to another indicates that supply, delivery mechanisms, and local demand are not perfectly interchangeable. This does not imply global shortages, but it does suggest that physical availability and logistical constraints matter more than they did during periods of abundant liquidity. Regulatory enforcement is another important link in this chain. When exchanges increase scrutiny or tighten compliance, trading behavior tends to change. Leverage is often reduced, speculative activity becomes more cautious, and liquidity can temporarily thin. These effects are structural rather than emotional, and they influence how prices move even without any change in underlying demand. Beyond market mechanics, government policy plays a longer-term role. The inclusion of silver in official lists of critical or strategic materials signals that policymakers view it as economically and industrially significant. Such classifications do not automatically lead to stockpiling or intervention, but they do affect how institutions, manufacturers, and long-term planners assess risk. The first groups impacted by these dynamics are typically industrial users and large market participants. Industrial buyers must manage input costs and delivery timing, while institutional traders must navigate shifting liquidity and regulatory frameworks. Retail investors are usually affected later, often through increased price variability rather than through direct supply constraints. Second-order effects emerge as these adjustments compound. Higher volatility can discourage short-term leverage while encouraging longer holding periods. Regional premiums can influence trade flows and inventory management. Increased regulatory attention can reduce certain forms of speculative excess without eliminating price movement altogether. Importantly, none of these effects require a crisis to be present. They arise from gradual changes in how markets are structured, how risk is managed, and how governments prioritize resources. Understanding this distinction helps separate structural adjustment from narrative-driven fear. This is why recent developments matter, not because they guarantee a particular outcome, but because they indicate that the operating environment for silver has become more complex and more sensitive to underlying conditions than in the recent past. Periods of heightened volatility in the silver market are not new. Looking back over several decades, there have been multiple instances when silver experienced sharp price movements alongside rising uncertainty in the broader financial system. These periods often coincided with transitions in monetary policy, shifts in inflation expectations, or changes in industrial demand. One relevant comparison can be found during the late 1970s and early 1980s. At that time, silver prices moved rapidly amid high inflation, currency instability, and geopolitical tension. What mattered most in the lead-up was not the final price outcome, but the buildup of conditions: constrained supply responsiveness, growing investor interest in hard assets, and policy uncertainty around inflation control. Another period worth noting occurred in the aftermath of the global financial crisis. Between 2009 and 2011, silver prices rose sharply as central banks implemented unconventional monetary policies. In the years leading up to that move, liquidity was abundant, real interest rates were low, and investors were reassessing traditional risk models. Volatility increased before prices reached their eventual highs, not after. However, it is equally important to recognize what is different today. Unlike the 1970s, inflation dynamics are more globalized and policy responses are more coordinated across major economies. Unlike the post-2008 period, current conditions involve tighter monetary policy and greater emphasis on balance sheet discipline rather than expansion. Another key difference lies in silver's industrial role. Over time, silver has become increasingly embedded in technology, energy transition infrastructure, and advanced manufacturing. This structural demand component was less pronounced in earlier cycles and adds a layer of complexity that historical comparisons alone cannot capture. History also shows that volatility itself is not a reliable predictor of long-term direction. In some past episodes, heightened volatility preceded sustained advances. In others, it marked transitional phases before consolidation or decline. What mattered more than price action was how policy, liquidity, and real demand evolved after volatility emerged. For this reason, historical context should be used as a reference frame, not as a roadmap. It helps investors recognize that strong price movements and uncertainty are recurring features of markets under stress or transition. At the same time, each cycle is shaped by its own combination of economic structure, policy response, and technological change. Understanding what is similar and what is not allows for a more disciplined interpretation of current conditions, reducing the temptation to project past outcomes onto a fundamentally different environment. Rather than focusing on a single expected outcome, professional market analysis relies on scenarios. Each scenario is defined not by certainty, but by conditions. The purpose is not to predict which path will occur, but to understand how the market might respond if specific variables change. Bull case, conditions for continued strength. In a constructive scenario for silver, several conditions would need to align. If global uncertainty remains elevated and real interest rates stabilize or decline, silver could continue to attract both financial and industrial demand. In this case, investor allocation toward hard assets would likely persist, not as a reaction to fear, but as part of portfolio diversification. If regional premiums remain in place, particularly in markets where physical demand is strong, this could signal sustained tightness in localized supply chains. Under such conditions, volatility would likely remain high, but price action could trend upward over time rather than revert quickly. This scenario does not require a crisis or supply disruption. It depends primarily on persistence, uncertainty staying elevated, policy remaining cautious, and industrial demand continuing at current levels. Base case, stabilization and range-bound behavior. The base case assumes that current conditions gradually normalize without resolving entirely. If uncertainty indicators level off rather than continue rising, and if monetary policy remains restrictive but predictable, silver prices could stabilize into a broad trading range. Volatility would likely remain above long-term averages but lower than recent extremes. In this environment, regional premiums could narrow as inventories adjust and trade flows respond. Regulatory oversight would continue, but without major structural changes that significantly alter market access or liquidity. This scenario reflects historical patterns where periods of elevated volatility are followed by consolidation rather than immediate continuation or reversal. For many participants, this would be a phase of reassessment rather than decisive positioning. Bear case, what would change the trend decisively? A less constructive scenario would emerge if key supporting conditions weaken. If real interest rates rise meaningfully and remain elevated, holding non-yielding assets like silver becomes less attractive for financial investors. At the same time, if global growth slows sharply, industrial demand for silver could soften, reducing one of its structural supports. If liquidity tightens further and risk appetite contracts across asset classes, silver could experience sharper downside moves, particularly given its higher volatility profile. In such a scenario, price declines would reflect deleveraging and repositioning rather than a judgment on silver's long-term relevance. This scenario does not imply systemic failure or structural collapse. It simply reflects the sensitivity of silver to shifts in rates, growth expectations, and liquidity conditions. Scenario takeaway. Each scenario highlights a different path driven by identifiable variables. None of them rely on extreme assumptions, and none are presented as inevitable. The value of scenario analysis lies in preparation, understanding what to monitor and how risk exposure might change as conditions evolve. When markets enter periods of heightened volatility, the most important discipline is to focus on indicators that reflect underlying conditions rather than surface-level narratives. For silver, several key variables consistently provide insight into whether recent price behavior is being supported or challenged. One of the first indicators I monitor is the US dollar index. Because silver is priced globally in dollars, sustained strength or weakness in the dollar directly affects international purchasing power and cross-border demand. A stable or weakening dollar tends to ease pressure on commodities, while persistent dollar strength can act as a headwind. Interest rates are another critical input, particularly real yields. Nominal yields alone do not tell the full story. What matters is the relationship between yields and inflation expectations. When real yields rise, holding non-yielding assets becomes more expensive in opportunity cost terms. When real yields stabilize or decline, that pressure eases. Inflation data such as CPI and PCE are relevant not because of the headline numbers, but because of how they influence policy expectations. Markets respond less to the level of inflation and more to whether inflation trends are changing in ways that could alter central bank behavior. Within the silver market itself, volume, liquidity, and open interest provide important context. Rising prices on declining volume often indicate reduced conviction, while sustained volume alongside stable liquidity suggests broader participation. Changes in open interest help distinguish between short-term positioning shifts and longer-term capital allocation. I also pay close attention to regional pricing and delivery dynamics. Persistent premiums or discounts can signal localized imbalances that are not immediately visible in benchmark prices. These differences often reflect physical market conditions rather than speculative activity. Finally, regulatory developments matter insofar as they affect access, leverage, and transparency. Increased oversight can alter trading behavior even without changing supply or demand fundamentals. Together, these indicators form a framework. None of them offers certainty on their own, but taken collectively, they help filter noise and anchor analysis in observable data rather than emotion. Periods like this tend to test investors, not because prices are unpredictable, but because narratives become louder than data. Volatility often creates pressure to act quickly, even when conditions call for patience and restraint. What matters most in environments like the current one is not guessing where prices go next, but understanding how risk is evolving. Silver, by its nature, will remain sensitive to shifts in liquidity, policy expectations, and industrial demand. That sensitivity is not a flaw, it is a characteristic that requires disciplined management. This analysis is not about making a call or drawing a line in the sand. It is about staying grounded in observable indicators, recognizing uncertainty for what it is, and avoiding decisions driven by emotion rather than structure. Risk management, position sizing, and time horizon matter more now than at any single price level. Markets move in cycles, but capital preservation and consistency are what allow investors to stay in the game long enough for those cycles to matter. This isn't investment advice, it's simply how I'm reading the market right now.